So it's no secret now that the stock market and the economy are plummeting. With the S&P 500 dropping nearly 16% since the beginning of 2022, we're well within what people call a recession. And without a light at the end of the tunnel, with knowledgeable individuals stating that there's going to be worse drops coming, with tons of people fleeing the stock market to find safer means of investments for their money, some of you out there are trying to put yourself in an advantageous position for when the stock market decides to bounce back. And I respect that. So in this video, we're going to be changing it up a bit. We're going to be talking about the 7 best monthly dividend ETFs to help you come out ahead in 2023. Yep, you heard me right. The dividend ETFs that we'll be talking about today give you monthly dividend checks instead of the typical quarterly checks. So in this video, we'll be breaking down the top 7 best monthly dividend ETFs in my opinion. And before I waste any more of your precious time, let's jump right into this video and talk about number 7. At number 7, we have the SPDR Dow Jones Industrial Average ETF Trust, or DIA. Its goal is to seek to provide investment results that before expenses correspond generally to the price and yield performance of the Dow Jones Industrial Average. This monthly dividend ETF is one of the few out there that directly plays for the Dow Jones Industrial Average, which itself is the oldest out of the different stock indexes and is comprised of the 30 of the largest publicly owned companies trading on the New York Stock Exchange and the NASDAQ. Established in 1998, it's the oldest ETF talked about on this list, and while there are a ton of different dividend ETFs that have higher dividend yields, DIA has been consistent in terms of providing high quality annual return rates every single year, as well as providing a good amount of dividend yield as well. If we look at DIA's historical performances, its year-to-date daily total return is negative 5.71%, its 1-year daily total return is negative 4.76%, and its 3-year daily total return is 8.88%, with the previous 5 years advancing an average of nearly 16% per year. Again, DIA primarily focuses on the Dow Jones Index, so its investments are extremely diversified, with the top 3 holdings being in healthcare with 22.88%, financial services with 20.33%, and technology with 15.3%. Within the top 10 holdings, which comprises of more than 50% of DIA's total assets, are notable companies such as United Health Group, the Home Depot, and Visa. DIA is currently trading at $337.79 per share, with a year-to-date daily total return of negative 5.71%, which isn't bad at all considering that the S&P 500 has dropped more than 15% over the course of 2022, and has $29.21 billion in net assets and has a PE ratio of 3.42 and an extremely low expense ratio of 0.16%. And what the expense ratio is a measure of how much you, as an owner of the ETF fund, will pay over the course of a year. The money will be used to pay for things like managing the fund, marketing, advertising, and generally just anything to upkeep the fund to keep going. So the general takeaway about the expense ratio is that we want it low. Generally, anywhere less than 0.5% is what we call a great or good expense ratio. Its dividend yield is on the lower side, definitely, clocking in at only 1.91% annually. However, when you incorporate the annual return of this monthly dividend ETF into the mix, you can start to see why this dividend ETF is talked about. Moving on to number 6 is Invesco's S&P 500 High Dividend Low Volatility ETF, or SPHD for short. Its primary goal is to invest at least 90% of its total assets into common stocks that comprise the index. S&P 500 compiles, maintains, and calculates the index, which is composed of 50 securities trading on the S&P 500 index that have historically high dividend yields and low volatility. Established in 2012, it just crossed its 10-year mark and is arguably one of the best performing dividend ETFs of 2022. It has a pretty solid dividend yield of nearly 4% with a YTD daily total return of negative 2.89%, which is pretty surprising because this dividend is focused on the S&P 500, but if you look at the S&P 500 chart, you can clearly see that it's down more than 15% year to date. Like I said previously, it's primarily focused on 50 of the highest paid dividend and low volatility stocks in the S&P 500, with the 3 largest sectors being in utilities at 19.27%, real estate at 18.28%, and consumer defensive at 12.52%. Within the top 10 holdings, which comprises of only 27% of the this monthly dividend ETF's total assets are companies like Philip Morris International, Chevron, and Altria Group. SPHD is currently trading at $44.60 per share, with net assets clocking in at $3.69 billion. Again, its dividend yield is 3.94% with a YTD daily return of only negative 2.89%. It also has a pretty good low expense ratio of 0.3%. Remember, we want an expense ratio that's less than 0.5%. And taking a look at its annual performance on top of the negative 2.89% YTD daily total return, we have 1.45% for the 1-year daily total return and 3.83% for its 3-year daily total return, with the previous 5 years advancing an average of 8% per year. Now, up until the point of this video, you're probably thinking to yourself, Eric, there's a ton of different dividend stocks and ETFs that pay way higher in dividend yields. Why would I subject myself to a low dividend yield like SPHD or DIA? And to answer that question, some of these high-paying dividend yield stocks are what you call dividend traps. You see, while something like an 8% or higher dividend yield looks great initially, when you blow up the stock chart to their max timeline, it tells a different story. For example, Big Lots, I used to see a ton of these big Walmart-like stores all across my city, but notice that over the years, one after other would shut down. If you look at their all-time stock chart, you can see why. Over the course of 1985 till now, it's fluctuated a ton, with the current dividend yield of 7.14%, which is much higher than DIA or SPHD. If you had bought Big Lot at the beginning of this year, you would have lost 60% of your initial principal. Another reason why I recommend ETFs is because most ETFs cover a wide range of companies, making it harder for them to entirely collapse. Having all of their eggs divided up into different baskets means overall less risk than someone who puts all of their eggs in one basket. Alright, number 5 is none other than WisdomTree's US High Dividend ETF, or DHS for short. DHS is a fundamentally weighted index that measures the performance of companies with high dividend yields selected from the WisdomTree US Dividend Index. These stocks are given a composite risk score that is an average of 3 factors: value, quality, and momentum. Once these composite scores are evaluated, this monthly dividend ETF buys stocks accordingly. Established in 2006, out of the 16 years it's been around, it's clocked in only 4 of those years as red years. It has a dividend yield of 3.32%, which is only a smidge lower than SPHD, the ETF that we just talked about, and has a rare YTD daily total return of 7.84%. Rare because it's performing positively while the rest of the stock market seems to be going down. In its top 3 sectors, it's primarily focused on energy with 22.71%, healthcare with 20.57%, and consumer defenses with 16.63%. With its top 10 holdings accounting for 45% of its total assets, noticeable companies are again Philip Morris International, Altria, and oh, look at that, Coca-Cola. DHS is currently trading at $87 per share, with net assets amounting to $1.31 billion. It's got again a pretty low expense ratio of 0.38%. And taking a look at some of its yearly performance numbers, it's pretty jaw-dropping as well. Again, its YTD daily total return is 7.84%, its 1-year daily total return is 11.84%, and its 3-year daily total return is 8.47%, with the previous 5 years advancing an average of 8.88% per year. Over the course of the last 10 years, it's gone from $45 to nearly $90 today, meaning if you were to invest $10,000 into DHS 10 years ago, your $10,000 nest egg would have turned into a $20,000 nest egg. Again, the reason why I recommend ETFs over buying one single stock is because ETFs tend to have a super diversified portfolio, which allows for less risk. Granted, if you're going for a riskier play, by all means, be one of those single stock portfolios. Moving on to number 4, let's talk about Invesco Preferred ETF, or PGX. Its objective is to copy performance and yield of ICE BofAML Core Plus Fixed Rate Preferred Securities Index. Established in 2008, its annual total return performance speaks for itself, clocking in only 2 years that they were barely negative in. Although, if you look at its YTD or 1-year daily total return right now, it's currently not doing so hot. But I digress, the overall market isn't doing so hot right now, so PJX definitely has room it can improve on. PJX's current price is $11.82 per share and has a dividend yield of 6.17%, making it the highest dividend yield monthly ETF up until this point of the video. With net assets hitting nearly $5 billion and an impressive track record over the course of the last 14 years, I'm convinced that PJX will bounce back. At number 3, we have KBW, High Dividend Yield Financial ETF, or KBWD for short. This monthly dividend ETF has about $350 million in net assets and primarily focuses on U.S. financial companies with high dividend yields. In my opinion, as rising interest rates persist, financial stocks generally do better, so KBWD has the potential to have a real uptick in the upcoming year. With 60% of its investments being in financial services and 37% being in real estate, some of the most held companies in its short list of holdings are companies you probably haven't heard of. I mean, personally, the only one that I recognize is Goldman Sachs. But what makes this stock interesting, aside from its potential to do well in a rising interest rate environment, is its high dividend yield of nearly 11%, meaning for every $10,000 you invest in this monthly dividend ETF, you're earning $1,100 in dividend checks every single year. Maxing out KBWD's stock timeline, you can see that it's normally trading around $20 to $25 a share, especially during the pandemic when it dropped to nearly $10 a share before bouncing back with the entire stock market. So yeah, in terms of risk, it's definitely one of the riskier plays out there, so you definitely want to do some research before investing into KBWD. And taking a final look at KBWD's annual total returns history, it's only marked 3 times since its inception where it entered bear territory. At number 2, we have DIVO, or Amplify CWP Enhanced Dividend Income ETF. This monthly dividend ETF has about $1.7 billion in net assets, with its strategy being an actively managed ETF of high quality, large cap companies that have a history of dividend growth. It also uses strategic covered call strategy, with primary focuses on sectors such as healthcare, financial services, and energy. Its top 10 holdings are familiar names such as United Health Group, Chevron, and Johnson & Johnson, the family company. And while the S&P 500 has dipped around 15% over the course of 2022, the DIVO has remained strong with only a little under 2%. Pulling up the DIVO's annual total return chart, you can see that this ETF is definitely worth putting some money into, with nearly 20% returns every single year since its inception, with exception to 2018, and an impressive 11.9% 3-year daily total return. It also got an above average dividend yield compared to others that I've talked about today, with 4.86%, with a low expense ratio of 55%, which means for every $10,000 you invest, you'll be earning $486 annually from this dividend and paying $55 with the expense ratio. And finally, the number 1 monthly dividend ETF that we'll be talking about today is none other than JP Morgan's Equity Premium Income ETF, or JEPI for short. This monster of an ETF holds $12.56 billion in net assets, the largest ETF out there of any that we've talked about today. This ETF primarily focuses on stocks from the S&P 500 with a curated algorithm to identify value stocks with low risk and good returns. It then uses that information to rank stocks based off of volatility and uses covered call options. Its aim is to have similar returns to the S&P 500 index and provide monthly income through dividends. Its primary holdings are typical S&P 500 stocks such as Microsoft, Google, and DTE Energy, and focuses on sectors such as industrials, healthcare, and financial services. Taking a look at JEPI's annual total return history, it's only been inception since 2020, but for 2021, it had an annualized return of 20%. However, its current year-to-date total return for 2022 is only negative 4.36% versus the S&P 500's, which is negative 15%. Its expense ratio is extremely low at 0.35% and has a dividend yield of 11% at the time of recording this video, which makes it the second lowest expense ratio on this list behind DIA, but also the second highest dividend yield behind KBWD. And finally, before I end this video, I think I have to do it justice and explain what dividend yields are and how to calculate them. A dividend is basically a check that's paid to you on a monthly or quarterly basis as a way to thank you for investing in whatever dividend stock company you own. It's a way for companies to share their wealth with its investors shares in hopes that you'll use that money and reinvest it back into the company. Granted, that's not something that you have to do. And to find a dollar amount from an ETF or dividend paying stock, all you have to do is find the dividend yield and the price of each stock of the company or ETF you're buying and multiply those numbers together. So for, let's say, JEPI, its dividend yield currently sits at 11.04%. Each share of JEPI at the time of recording this video sits at $53.91. But to make this math a little easier, let's round it to $54 even. Then all you have to do to find the amount this ETF will pay you on a yearly basis is multiply 11% to $54, which gives you an annual dividend amount for each share of JEPI you own. And to find a monthly dividend amount JEPI will send you, all you gotta do is divide this number by 12, since there's 12 months in a year. So by owning one share of JEPI, you'll earn nearly 50 cents per month of passive income just by owning that ETF. Now obviously, the higher amount of shares you have with certain dividend ETFs or stocks, the higher the amount of dividend you'll be making per year. For example, if you have 1,000 shares of JEPI, you'd be earning $500 a month in passive income with $54,000 invested into this monthly dividend ETF. This is how some people are able to completely live off of dividends alone. The snowball effect is slow at first, but slowly and surely it gets bigger over time. Alright, it's time to wrap up this video. If you found any of the information within this video to be helpful today, make sure to subscribe to the YouTube channel. It definitely helped me put a smile on my face and helped me grow this YouTube channel. Also, consider entering the current giveaway that I'm doing with extra wallets. All you have to do to participate into potentially winning one of 5 extra wallets is 1, subscribe to my YouTube channel, 2, subscribe to Extra's YouTube channel, and 3, comment in the comment section down below about which wallet you want and why. Also, don't forget to leave a like and ring that notification bell. Thank you for watching as always. Until next time, everybody, stay safe out there. Peace.